Today, we're on a mission to figure out why global banking is on shaky ground. Join us as we look into the key moments that have shaped how money works worldwide. The roots of modern banking extend deep into the annals of history, finding their earliest manifestations in the financial systems of ancient civilizations. Mesopotamia, with its temples doubling as centers of commerce, saw the birth of rudimentary banking practices. Here, amidst the exchange of goods and services, temples also served as depositories for wealth, facilitating transactions through the recording of deposits, loans, and currency exchanges. Similarly, in ancient Egypt, a burgeoning agricultural economy gave rise to the establishment of grain banks, allowing farmers to store surplus crops for future use or trade, laying the groundwork for more sophisticated financial systems to come. As civilizations progressed through the Middle Ages and into the Renaissance, banking evolved alongside the burgeoning trade networks of Europe. Italian city-states like Florence and Venice emerged as financial powerhouses, with influential banking families, such as the Medici and the Fuggers, facilitating international trade through the issuance of bills of exchange and the provision of credit to merchants. The Renaissance period witnessed further institutional advancements, with the establishment of public banks, like the Bank of Amsterdam, which provided critical financial services and helped fuel the era's exploration and trade ventures, marking a significant step toward the modern banking landscape. The turning point in the evolution of banking came with the establishment of the Bank of England in 1694. Created to finance England's war efforts, the Bank of England became the world's first central bank, issuing banknotes, managing government finances, and serving as a lender of last resort. This model of central banking set the stage for the development of similar institutions worldwide, laying the foundation for modern monetary policy and financial regulation. The Industrial Revolution of the 18th and 19th centuries ushered in a new era of banking innovation. With the proliferation of industrial enterprises and the expansion of global commerce, the demand for capital soared. Joint stock banks and investment banks emerged to meet this demand, providing financing for industrial projects and spurring economic development on an unprecedented scale. The 20th century brought further advancements in banking and finance, culminating in the establishment of the Federal Reserve System in the United States in 1913. Designed to stabilize the country's banking system and regulate the money supply, the Federal Reserve set a new standard for central banking practices, serving as a model for central banks worldwide. Additionally, the Bretton Woods Agreement of 1944 laid the groundwork for the post-war international monetary system, establishing institutions like the International Monetary Fund and the World Bank to promote global financial stability and facilitate economic cooperation among nations. In conclusion, the historical evolution of banking reflects a journey from the rudimentary financial systems of ancient civilizations to the complex and interconnected banking systems of today. Each milestone, from the establishment of early banking institutions to the creation of central banks and international financial organizations, has left an indelible mark on the modern financial landscape, shaping economic development and globalization on a global scale. Banks serve as the lifeblood of the global economy, orchestrating the intricate dance of capital flows and financial transactions that underpin economic activity on a massive scale. At the heart of banking lie three fundamental functions: deposit taking, lending, and financial intermediation. Through deposit taking, banks provide individuals and businesses with a safe and secure repository for their funds, offering a range of accounts tailored to meet diverse financial needs. This influx of deposits forms the cornerstone of banks' lending activities, enabling them to extend credit to borrowers seeking capital for various purposes. Whether financing consumer purchases, supporting small businesses, or funding large-scale infrastructure projects, banks play a pivotal role in allocating capital to its most productive uses, driving economic growth and prosperity. Yet, it is perhaps in their role as financial intermediaries that banks exert the most profound influence on the global economy. Acting as conduits between savers and borrowers, banks channel funds from surplus units to deficit units, matching the preferences of savers seeking returns on their investments with the financing needs of borrowers hungry for capital. This process of financial intermediation not only promotes economic efficiency and resource allocation, but also lubricates the wheels of commerce, enabling individuals and businesses to access the capital they need to thrive and grow. In facilitating economic growth, investment, and trade, banks serve as catalysts for progress, unleashing the transformative power of capital to drive innovation, create jobs, and spur development. By providing financing for capital-intensive projects and ventures, banks fuel investment in critical areas such as infrastructure, technology, and renewable energy, laying the foundation for sustainable growth and prosperity. Moreover, banks play a vital role in facilitating international trade by providing trade finance services such as letters of credit, export financing, and currency exchange, smoothing the flow of goods and services across borders and fostering economic integration on a global scale. Central to the functioning of the banking system is the bedrock of trust and confidence. Trust is the currency of banking, the glue that holds together the intricate web of relationships between banks, depositors, investors, and regulators. When depositors have confidence in the stability and reliability of banks, they are more likely to entrust their savings to them, confident that their funds will be safe and secure. Conversely, a loss of trust can have devastating consequences, triggering bank runs, financial contagion, and systemic crises that reverberate throughout the economy. Therefore, maintaining trust and confidence in the banking system is paramount, requiring banks to adhere to rigorous standards of risk management, transparency, and accountability. The role of banking in the global economy is multifaceted and profound, encompassing a wide array of functions and responsibilities. From mobilizing savings and allocating capital to facilitating economic growth and promoting financial stability, banks play a central role in shaping the economic landscape. Yet this role comes with great responsibility, requiring banks to uphold the highest standards of integrity, prudence, and ethical conduct. Only by earning and preserving the trust and confidence of their stakeholders can banks fulfill their mission of fostering prosperity and advancing the collective well-being of society. The global banking system, despite its crucial role in facilitating economic activity, has faced significant criticism and encountered numerous challenges throughout history. From exacerbating income inequality to contributing to financial instability and systemic risk, banks have come under scrutiny for their impact on society and the economy. One of the most pressing criticisms of the global banking system is its role in perpetuating income inequality. While banks play a vital role in allocating capital and providing financial services, they have been accused of favoring the wealthy and exacerbating socioeconomic disparities. For example, banks may offer preferential treatment to high-net-worth individuals and corporations, providing them with access to favorable interest rates, investment opportunities, and specialized financial products that are out of reach for the average consumer. This concentration of wealth and resources among the elite can widen the gap between the rich and the poor, exacerbating social divisions and undermining economic stability. Furthermore, the global banking system has been plagued by episodes of financial instability and systemic risk, which can have far-reaching consequences for the economy. Financial crises, characterized by widespread panic, bank failures, and economic downturns, have been a recurring feature of the modern banking landscape. Specific instances of banking crises throughout history serve as stark reminders of the vulnerabilities inherent in the financial system. One of the most infamous banking crises in history is the Great Depression of the 1930s, triggered by a combination of factors, including excessive speculation, over-leveraging, and banking panics. The Great Depression resulted in widespread bank failures, mass unemployment, and economic devastation. The collapse of thousands of banks wiped out savings, destroyed businesses, and plunged millions into poverty, underscoring the systemic risks inherent in an unregulated financial system. More recently, the 2008 financial crisis brought the global banking system to its knees, exposing widespread misconduct, lax regulation, and systemic weaknesses. The crisis, fueled by risky lending practices, subprime mortgage fraud, and complex financial derivatives, led to the collapse of major financial institutions, a global credit crunch, and the worst economic downturn since the Great Depression. The repercussions of the crisis were felt around the world, with millions losing their homes, jobs, and life savings, highlighting the interconnectedness of the modern financial system and the need for stronger oversight and regulation. In addition to contributing to financial instability, banks have been criticized for exacerbating income inequality and widening social divisions. By catering to the needs of the wealthy elite and neglecting the interests of low-income individuals and marginalized communities, banks can perpetuate disparities in access to credit, wealth accumulation, and economic opportunity. For example, discriminatory lending practices, such as redlining and predatory lending, have deprived minority communities of access to affordable credit and housing. exacerbating racial and socioeconomic inequalities. Moreover, the concentration of economic power and influence in the hands of a few large banks can undermine competition, stifle innovation, and limit consumer choice, further entrenching the dominance of established players and hindering upward mobility for aspiring entrepreneurs and small businesses. This concentration of power can also breed corruption, cronyism, and regulatory capture, eroding public trust in the banking system and undermining its credibility as a force for good in society. Thanks for joining us on this journey through the intricate world of global banking. From its inception to its current state, we've explored the complexities and challenges of a system that shapes economies worldwide. If you enjoyed diving into the history of global banking with us, don't forget to like, share, and subscribe for more insightful content. Until next time, keep questioning, keep learning, and keep evolving. See you soon.